Japan's inflation crisis, political turmoil, and BOJ's tough choices in 2025. Navigating the turbulent waters of Japan's economic landscape feels like a political roller coaster ride, with no sign of a smooth landing anytime soon. Imagine being Japan's central banker, Kazuo Ueda, tasked with steering the country's monetary policy during a period of soaring inflation and political upheaval. While Fed Chair Jerome Powell faces his own set of challenges, like the looming threat of being fired by President Donald Trump, the stakes for Ueda are even higher. Powell's recent visit to Fed headquarters, complete with a hard hat, underscores the unpredictable nature of his job. However, the economic indicators paint the clearer picture for the Federal Reserve. Arguments for cutting interest rates are more about political allegiance than sound economic reasoning. Core inflation is climbing at a rate of 2.9% annually, and with tariffs expected to add to costs, lowering rates could inadvertently fuel speculation among investors, potentially increasing U.S. Treasury yields. The decision Ueda's team faces at the upcoming July 30th to 31st policy meeting is particularly daunting. Most experts believe they'll maintain the status quo. However, there's pressure to hike rates by 25 basis points to 0.75%, signaling the Bank of Japan's commitment to its normalization strategy. Yet history serves as a cautionary tale. In 2007, the BOJ raised rates to 0.5%, only to reverse course by 2008, in the wake of the financial crisis, returning to zero rates and resuming quantitative easing. Will Ueda find himself in a similar predicament, forced to backtrack on rate hikes starting in July 2024? The answer remains uncertain, especially given Japan's recent trade agreements with the U.S., the avoidance of a 35% tax, settling for a 15% Trump-imposed tax instead, and the escape from a 25% tariff on auto exports are positive developments. However, these gains are overshadowed by a contracting economy. Japan's GDP shrank by 0.2% in the first quarter, and the second quarter saw a perfect storm of tariffs, domestic inflation, and surging bond yields dominating the headlines. As we enter the third quarter, Japan's economic engine isn't running at full capacity. Slowing Chinese exports and deflationary pressures, coupled with lackluster growth in the US and Europe, are dampening demand for Japanese goods. The combination of inflation and stagnant economic growth pushes Japan closer to the brink of stagflation. Predicting the BOJ's future moves is akin to guessing the weather. Ueda's decisions will be influenced by both economic data and political dynamics. The July 20th election saw the ruling Liberal Democratic Party lose control of the upper house, leaving them without direct control over either chamber of parliament. Forming a coalition government will be crucial, and Prime Minister Shigeru Ishiba may step down to take responsibility for the shift in power. One potential outcome of this political realignment is a push for lower taxes, which could unsettle the bond market. Ishiba's previous success in avoiding large-scale stimulus packages is about to be tested. Increased government spending to stimulate the economy will exacerbate Japan's already heavy debt burden. Last week, the auction of 40-year Japanese government bonds, JGBs, saw the weakest demand since 2011. A routine sale of $6.9 billion in 20-year bonds in mid-May yielded some of the worst results since 1987, with the gap between average and lowest accepted prices reaching its worst level in 38 years. When #JGB crash trends on social media, it's a red flag for investors. If the BOJ raises rates amid increased government borrowing, Japanese borrowing costs can soar, heightening the risk of recession. Conversely, if Ueda accommodates inflation, leading to sustained high prices, the BOJ might need to tighten monetary policy more aggressively later in 2025 and beyond. In this whirlwind of economic and political uncertainty, one thing is certain: 2025 can't come quickly enough for Ueda and his team. But here's where it gets controversial. Should central banks prioritize economic stability over political considerations, or vice versa? What do you think? BOJ keeps interest rates unchanged amid economic uncertainty. The Bank of Japan, BOJ, is poised to maintain its current interest rates during the upcoming monetary policy meeting, as the economic landscape remains fraught with uncertainty. This decision is not taken lightly. Many officials within the central bank believe that a cautious wait-and-see strategy is essential, especially in light of the ongoing economic unpredictability, despite the recent trade agreement between Japan and the United States. Scheduled for discussions on Wednesday and Thursday, BOJ policymakers are anticipated to keep the short-term policy rate steady at 0.5%, a level that has been unchanged since January. This stability reflects a broader strategy to navigate the complexities of the current economic environment. Moreover, there is a possibility that the central bank will revise its inflation forecast for the fiscal year 2025, potentially increasing it from the previously projected 2.2%. This adjustment is largely attributed to the rising costs of food, which have been impacting consumer prices. Interestingly, the earlier report from May indicated that tariffs imposed by U.S. President Donald Trump could exert downward pressure on Japan's economy, adding another layer of complexity to the situation. As we delve into these developments, one must ask, is the BOJ's cautious approach the right strategy in such turbulent times? Or could a more aggressive stance yield better results? Share your thoughts in the comments below. U.S.-Japan tariffs deal fuels inflation. Will the BOJ raise rates early? A surprising trade deal between the U.S. and Japan could force the Bank of Japan to make its biggest policy shift in decades, and the clock is ticking faster than anyone predicted. Here's when economists are scrambling to rethink their forecasts. The hidden inflation bomb, how a 15% tariff deal is reshaping Japan's economic future. The recently announced U.S.-Japan trade agreement, slashing tariffs to 15% and securing a $550 billion Japanese investment in America, isn't just about trade balances. It's quietly becoming the trigger for what could be Japan's first major interest rate hike in years. But here's where it gets controversial. Barclays analysts now predict the Bank of Japan BOJ might raise rates as early as October 2024, months ahead of previous estimates. Why this changes everything. Under the deal, Japan will open its markets to U.S. cars, trucks, and agricultural products while shielding its manufacturers from crushing 24% tariffs. This relief, Barclays argues, could be the missing piece for Japan's inflation puzzle. With corporate pressure easing, analysts see a 4.5% wage hike in 2025 spring negotiations as increasingly likely, a critical factor for the BOJ's elusive 2% inflation target. Wait, there's a twist. The same agreement also forces Japan to accept more U.S. imports. While this stimulates competition, could it secretly undermine domestic industries? The BOJ's deputy governor, Masazumi Wakatabe, seems optimistic, calling the deal a game-changer for economic stability, but skeptics warn of hidden costs. The domino effect you didn't see coming. Let's break down the numbers. Japan's 2025 GDP growth forecast just jumped 0.3% to 0.8%. Previous projections had slashed growth to 0.5% under tariff threats. Manufacturing wage growth could now outpace service sectors. Here's why this matters for everyday consumers. Higher wages in factories, where tariffs hit hardest, could create a ripple effect across Japan's economy. But here's the catch. 75% of Japanese workers are in non-manufacturing jobs like healthcare and retail. These sectors already face severe labor shortages and weren't waiting for trade deals to push for pay raises. The rate hike countdown begins. Barclays cites 3 triggers for an October rate hike. 1. Tariff relief achieved. Done. 2. Renewed yen depreciation risks. 3. Inflation overshooting BOJ targets. With the first box checked, all eyes are on summer economic data. Could premature rate hikes stifle Japan's fragile recovery? Or is this the long-awaited exit from decades of ultra-loose policy? Let's get real. If wages rise but import costs climb due to more U.S. goods flooding the market, will households actually feel richer? This paradox lies at the heart of the BOJ's dilemma. The burning question no one's asking. While analysts debate timelines, there's an elephant in the room. Is 4.5% wage growth even possible in manufacturing? Consider this. Even at 24% tariffs, companies could have afforded 3-4% raises. With tariffs halved, profit margins improve dramatically. Non-manufacturing sectors, desperate for workers, are already pushing 5% plus increases. But here's the kicker. If the BOJ moves too fast, it could overcorrect and trigger a recession. Move too slow, and inflation might spiral. What's your take? Do you think the Bank of Japan is right to consider earlier rate hikes, or is this an overreaction to temporary trade deal optimism? Could this policy shift accidentally hurt the workers it's trying to help? Drop your thoughts below. Let's get controversial.